Hi, and welcome back. Today we have a relatively short but a very important session where we're taking a look at the management of fixed assets. Fixed assets, of course, are part of total assets alongside of other assets like cash and working capital. Today we're specifically looking at the management of fixed assets, and for some businesses, the management of fixed assets is going to be very important. Others much less because of a lower capital intensity. Certainly older traditional style manufacturing businesses had a lot of capital invested and would turn over their capital very slowly. We see there's a significant change though in the way that even the largest manufacturing businesses operate today, with some choosing a strategy that essentially says we're not going to own our own capital, we're going to rent the capital assets we need from suppliers and essentially push a lot of the ownership further up the value chain. And sometimes not just outsourcing the production, but moving it to other countries. This is a part of the shareholder value proposition that we talked about earlier. Of course, shareholder value is measured by the return on assets, and the use of leverage depends significantly on the efficient use of assets. And by this, we're talking about fixed assets as well as working capital. And so even though our textbook kind of forgot to mention anything about fixed assets, we want to have a quick look at how we measure fixed assets and how we understand changes in the capital intensity. This is something that's covered in much more detail in economics, where we take a look at things like the efficiencies of scale and the trade-off between scale and flexibility. But of course, when we're looking at real companies, that's something we really have to understand. And of course, as part of an overall view, we need to consider the effect of profitability and also the effect of leverage. Now, you've probably seen this great picture from the internet. It's kind of a very good illustration of what happens when we overload a system. Sometimes in finance we describe this as overtrading, essentially that we have got an awful lot more business than we have ability to manage that business. Like this poor donkey's never going to manage to pull that cart. Not enough fixed assets, essentially we end up with the business breaking down. It can't meet its requirements because we don't have enough equipment to be able to fill our orders. The opposite is also possible. In fact, we've seen a lot of companies have gone completely the other way, where we've invested so much in fixed assets that we don't even need people anymore. We've got a fully automated plant. The robots have essentially taken over. This is clearly the opposite end of that spectrum, where we've gone full capital intensity. And of course, that's the trend of automation in most businesses, except thankfully in universities, at least so far. We can also have too much fixed investment, because remember, we have to fund the fixed investment with our capital. Capital is expensive, and we want to make sure that the capital that is employed in the business is working hard for us all the time. And a great example of that overcapacity or overinvestment in fixed assets appears when we are at airports around the world now, and we see aircraft parked everywhere. Now, of course, there is a pandemic, and presumably those aircraft are going to get back to work. But before the pandemic, we also had overcapacity in several areas, and airlines had overinvested in aircraft. And so they're parked in the Arizona desert waiting for improvements in their business. So having assets sitting idle is exactly the opposite of that poor donkey hanging in the air. We need to find an optimal balance, something that balances the advantages that we get from scale efficiency with the flexibility that we need to deal with business cycles. If we have a slowdown in the economy, well, perhaps if we have fewer assets, if we're a lean business, we have to worry about funding fewer assets. If the economy takes off, we lose a bit of that profitability that we would have if we were operating at a larger scale. So in this respect, good analysts and of course good managers have to be fortune tellers. They have to be able to look into the future and understand the significance of that capital intensity. Economists have told us about this ever since we started to talk about economics, the ideas of fixed and variable cost. On this chart, for example, you can see that we've got on the one axis the dollar value of revenue and our expenses. And across the bottom, we have the level of output, the volume that we're operating at the business. Of course, fixed costs, true fixed costs, are ones that don't vary with respect to volume. So things like investments in machinery, plants, having the building and the real estate in place, head office costs, things like that tend to be fixed investments, although there is a longer discussion about that as well. And so if we have to invest $1 million in our fixed investment, that investment is going to be a cost whether we're producing 1 unit or a million units of product. Revenue, of course, is going to increase with our level of sales, and so that's why it comes out of the origin, and it is a strict linear relationship, or at least in the economist case. Our variable cost is variable with respect to volume. And so if we do 1 unit, well, maybe we have to pay $1 per unit. And if we do 100 units, 100 times $1 means we've got $100 in cost. So that variable cost is going to be a linear relationship, again, out of the origin. But the slope is going to depend on the efficiencies of scale. If we have got a process that has got real scale efficiency, that slope is going to be very flat. If it's one with few scale efficiencies, well, the slope will eventually match that of revenue. This is going to be important because if we have a business where we can take advantage of a flat variable cost curve, then we're going to have a true advantage in our business. You can see how the total costs go together. We have our fixed investment per unit and our variable cost per unit. And when we add the green line and the dotted blue line together for each point on the axis, we end up with our total cost line. Now, that's just the sum of variable cost plus fixed cost. I'm sure you've seen that before. The most important thing that economists will tell us is that the level of output that we're going to try to target is the one where the cost, the total cost, equals the revenue. The cost of adding an additional unit of production is exactly equal to the marginal revenue that we get from 1 unit of production. And that essentially becomes our break-even volume. For example, if I wanted to start a new MBA program and I had to think about the way that I'm going to finance it, will I require classrooms, faculty? Those tend to be fixed costs. You can't decide to hire an extra professor because you've got another 10 students. So they tend to be fixed investments. We have a relatively high level of fixed investment. Variable cost per student in the new MBA program, well, we have to do a bit of printing. We have a little bit of extra overhead with respect to office work, perhaps, that is effectively variable. But the variable cost is essentially very flat. And so if we get 30 students in the class and we're well past our break even, adding student 31, 32, 33, and so on becomes essentially, well, I won't say pure profit. We don't use that word in universities, but I would say pure contribution margin. We can use that to cover some of the other overheads. That is a really good example of a high fixed cost environment. In fact, airlines kind of work the same way to a certain point. Adding 1 extra passenger to an airplane with empty seats, basically they have to buy an extra meal. That's pretty much the only variable cost. And so they typically have a high level of fixed costs. Other businesses may have, in fact, other companies trading in the same business might choose a different strategy. One MBA program that I worked with didn't own classrooms. They didn't have faculty, or at least not regular faculty. When that MBA program set up its offices in, for example, Hong Kong or Shanghai, they had a representative office where they hired a person that was going to work with the students. And then when they had classes, they would hire a teaching space, typically a room in a hotel, a big lecture or reception space, exhibition space in the hotel. They would have some of the things catered like coffee and sometimes lunches. they would hire professors from other universities, typically the good ones, and they would fly them out to teach that one class. That was treating all of the things like the classrooms, things like books were also part of the deal. That was also a variable cost. The faculty were also a variable cost. The variable cost curve was quite a bit steeper, and the fixed cost was very, very flat. So there they had dealt with the business very differently. So 2 university programs. One of them was a regular MBA run in the main campus. The other were programs that were run in different centers around the world. The regional centers were variable cost driven. The home center was fixed cost driven. Very different business strategy. The reason why I'm telling you this is because when we're anywhere to the left of that break-even point, in that yellow area, we've got a loss. That's our operating loss, negative operating profit, or negative EBIT. And if we drop below the break-even value by a slight amount, we have a small operating loss, but it becomes very big very fast because the size of the triangle, or the vector that the triangle meets at, is very large. It's a big triangle. So losses occur very quickly when you have high fixed investment. On the positive side, when you're anywhere to the right, because it is such a big triangle, profits increase. And so the blue area represents our operating profit. High fixed investment makes it easier to make a large gain. Now, we could choose an alternative strategy like the one that I mentioned of having low fixed costs. In this chart on the right, you can see the fixed cost line is very low. The variable cost line is quite a bit steeper, and that's because we've decided not to invest in our fixed investment. Instead, we're going to load more of the costs on a per student or a per unit basis, and so we've made that line quite a bit steeper. As a result, the total cost line is also steeper, and those 2 triangles also are a lot smaller. You see that if we're somewhere to the left of that break-even point, you're still losing money, but you're losing money in a smaller amount. You only have to cover the fixed costs. If you're to the right, though, and you're making a fair amount more than just the basic break-even level, you've got a lot more students or a lot more units, that means that we're going to make a smaller operating profit than we would have if we would have gone for scale efficiency. 2 companies will choose different approaches. One will decide that they're going to be all about flexibility. The model on the right is the flexible one, where we're going to have low levels of fixed investment. The one on the left says we're confident in our business. It's really going to take off. We're always going to be above these break-even levels. So let's go for high levels of fixed investment, high levels of automation. We'll choose to use machines rather than people for this because we know we're going to be above that break-even volume. And so we'll have a larger profitability. This is something that managers fight with all the time. They know that if we just make that extra large investment, we're going to make larger profits, but we're also taking a risk because what if our volumes don't meet our expectations? Companies in the same industry, and certainly companies in different industries, will have different levels of fixed investment. You can see in this example, I have just downloaded the level of fixed assets to sales for 4 different companies that are in the automotive business. Ford, Tesla, of course. Nissan, Magna is also in some markets known as Magna Steyr. It's an assembly business that mostly builds cars for other people. And you can see the level of fixed assets does vary from one company to another, but clearly Tesla is much more invested because they do everything. They make batteries, at least they do the battery assembly. They do car assembly, so they've decided we're going to invest much more in our fixed assets relative to the sales. So they've got a 52% fixed assets divided by sales ratio. Ford is the leanest in that respect because they outsource so much more of their production. And of course, when you start to take apart a Ford car, you see the stampings on some of the parts of many of the component suppliers. Perhaps it's Bosch or and several other companies that work for Ford who provide standardized products like windshields and upholstery and so on. So they have actually outsourced more of their production, and that puts them on the low end of the scale. Nissan apparently does do more of its work in-house. It has a higher fixed assets to sales. In fact, I'm even surprised Magna doesn't have a higher number, because it is all about automation and producing cars efficiently. I'm not quite sure why I've got Apple in here. They don't make cars, do they? Well, they are actually talking about it, but here I just wanted to use an example that wasn't in the car industry to see what another business might look like. And Apple, and quite notoriously, doesn't produce its own products. A lot of their products, most of their products, are produced by contractors, many of them in developing markets. And so for that reason, its fixed assets to sales ratio is very small. Now, in fact, even when they do start producing cars, as they plan to do apparently, or at least as is rumored, a contractor like Magna will probably end up owning the fixed assets that are used to produce those Magna cars. I can also take a look not just at the comparison, but the trend. For example, if I take a look at well, here I've got Boeing, and Boeing is a very interesting example. Over the last few years, Boeing has increasingly outsourced more of its production. It's closed down factories, and when it closes down those factories, quite often the production goes to contractors, so that, in fact, the Boeing 787 case was one that was used for supply chain management courses. You couldn't do supply chain management without learning about Boeing, because they decided for the Dreamliner that they were going to essentially create an airplane in a software system, and that would allow any of the contractors to have full access to the information that they needed to produce any of the components. So those components would meet up and become sub-assemblies, and then someplace else they would be assembled, and probably the airplane would only become an airplane at the end of a very long value chain where all the parts would hopefully come together and work okay. It didn't really work very well, and they also had some problems with their 737. But the trend has always been one of decreasing capital intensity, increasing outsourcing. And we can see that here. We have two ratios. They are essentially the same ratio. Fixed assets to sales, fixed assets divided by the total revenue. By the time we get to 2019, their fixed assets are 16% of their sales. They are turning over their fixed assets. Their fixed asset turnover is just the reciprocal of this. It's 6.09. They were turning over their fixed assets much more in 2015 at a rate of 8 times per year, or they had a capital intensity, a fixed asset sales ratio of 11.9. The number got a little bit higher in 2016, stayed fairly high in 2017, improved in 2018, and of course 2019, they appeared to have a much higher intensity. And see, didn't I just say something about increased outsourcing? Well, most of that happened beforehand, and you can see that one thing that does throw a wrench into that plan is a decrease in sales volume. So a number of product failures worldwide essentially led to a decrease in sales, and the fixed assets don't decrease with sales. So that's why we see the fixed assets to sales intensity rising, despite Boeing's plan to reduce their fixed assets. Of course, they will do other things to try to improve the situation, cutting jobs in their own factories, and that helps us to reduce some of the costs of the business. But of course, in a business like Boeing's, they can't really write off all of the assets just because they've had a bad year. That is kind of a quick introduction to understanding fixed asset management and fixed asset intensity. Essentially, fixed asset management is about the firm's choice of the amount of capital, the capital intensity, and that's going to reflect its strategy, how it's going to manage its supply chain, and also it's going to reflect the market conditions. A highly volatile market tends to suggest lower levels of fixed investment because flexibility becomes critical. In advance, we say a priori, it's very hard to say what choice is going to be best. It's like trying to bet on the stock market. The stock market going to go up or down next year? We really can't say for sure. Trying to anticipate a market like that, it's just too many unknowns, too many variables. And so anyone that tells you that they know what next year is going to bring is probably guessing. Very few successful market timers. So understanding, though, the rationale, the logic behind the management is what's important. And that's what analysts try to do. When we look at a company that is taking variable costs, especially that employment, out of their business and replacing it with increased machinery, they're increasing their fixed costs, and you say they must have a belief that the market is going to improve, that a higher break-even will be possible in the future. Decisions to break up our value chains, to outsource, to offshore, to downsize will reduce our capital intensity, and that may be a good thing, but of course it has a consequence in making us less cost effective if the market is good and if we're producing at a higher marginal cost than our competitors, and we end up being outpriced in the market because they have lower cost base, they can afford to cut their prices, they have the best capital efficiency. This has been a short and intensive introduction to the management of fixed costs. Alongside of working capital, that'll help you to understand the asset utilization that's part of the process of creating shareholder value. Thanks very much.